series, and today we'll look into 2023 and what can we expect. First of all, I just want, George, from your perspective, if we think about economic growth, how should we be thinking about that evolving for the year ahead? Well, sort of in this midst of China abandoning that zero COVID policy and how that might feed through into growth and obviously into inflation.
At the beginning of this year, we've started to see the moderation of inflation in areas such as France.
How does that feed into what central banks are thinking around inflation and the direction of travel for interest rates? So opportunities certainly created by the challenges that we saw in 2022 and how through 2022. Maybe the term that we need to use more in 2023 will be disinflation, and what that actually means across the globe as we look to the year ahead. Welcome to the first episode of our Do More With Your Money show for 2023. It's the 149th episode of the series, and today we'll look into 2023 and what can we expect. First of all, I just want to go around the panel that we're joined with today and get everybody's perspective on 2022. What were some of the key highlights from an investment perspective? And I'll maybe start with you, George, firstly.
A lot of highlights from 2022. Probably the main one is don't underestimate the power of central banks in terms of what they're trying to achieve and also how they communicate that along the way. The market has gone to great lengths to try and test the expectation of central banks throughout the course of the year, which has been one of the drivers of volatility, but also it's set the pathway in terms of where we go from 2023 onwards in terms of our starting point of interest rates, our starting point of financing and discount rates. So don't underestimate the power of central banks.
Okay. Raj, yourself?
I think it's just a reminder of a continuation of what we have been speaking about the whole year 2022 has been inflation, how surprisingly sticky the inflation has been, and the impact of the lockdown has been the delay in supply curves, and then the demand has been fairly strong. So inflationary pressures have economists and all of the market participants were expecting inflations to ease off, and that has continued to surprise. And hence, as George mentioned, that the central banks have had to act so aggressively over time. So I think that the stickiness of inflation is probably most surprising.
So central banks, stickiness of inflation. Kevin, what about for yourself?
So I'm going to pull the two together and say that sometimes your inflation hedges just don't work. So we've had one of the biggest impulses from inflation in 40 years, and gold price in dollar terms through the year was flat. Oil price, the WTI in the US was down, and if you're invested in global inflation-linked bonds, you'd have lost money. So big surge in inflation beyond expectations, inflation surprises, and yet your inflation hedges just wouldn't have worked.
And that's some of the key themes that we've been discussing as a team through 2022. And I think maybe the thing there to do at this point is if you're not a subscriber, please do subscribe to the podcast. Just click at the right-hand side now, and you'll get all of this great content on a daily basis into your email box. So let's look then into maybe 2023. Before we go there, Raj, could you maybe just give us a brief outline of how 2022 shaped out for asset markets?
Yes, of course. I think as we discussed that, and a few things which we had just highlighted, how difficult the 2022 market backdrop has been, be it inflationary pressures. To start with, the central banks were slow in tackling the inflationary pressure. So I think then they had to ram up the inflation interest rate much faster pace, and we saw that has been reverberating in across market, across every asset class, you name it. And the biggest surprise has been in the fixed income market. If you look at, as Kevin mentioned earlier on, the inflation-linked bonds and fixed income markets, bonds pricing have been the biggest hit outlier, and they have been bottom performer. Inflation-linked have lost around 27%, a quarter of their value over the global inflation-linked here I'm talking about. And so has been UK government bonds. Gilts market across the board has been down almost over 20%, something we have not seen in multi-decades. So I think that is the biggest outlier of the. So that has actually fed into every asset class you being priced on, be in equity markets, be it particularly on the growth-sensitive equity markets, which have been down across the board around 30% in 2022. Though we saw some positive momentum in FTSE, for example, the UK equity market, which was helped by a weakness in sterling.
Yeah.
That has been a big part of, given the almost 75-80% of the revenues are coming from FTSE 100 are coming from external, from overseas earnings. So that has weakness in sterling has meant that the FTSE have been the best performing developed market across the board in 2023. But contrastingly, if you look at the FTSE 250, that has not seen a similar kind of return. So we saw that the sterling weakness not being benefiting the domestically focused FTSE 250 markets. So that has been down around 15-17%. But similarly, if you look at sticking on the equity markets, Japanese equities have also fared better than other developed markets or emerging markets, down around 2 to 3%, depending on what is cut-off you lose. And that again benefiting from the weakness in Japanese yen we saw earlier on. Overall, equity markets have been come under pressure throughout the year, though we saw a quite a remarkable comeback in fourth quarter. In local currency terms, MSCI all country world is up around 16%. So quite a remarkable comeback towards the back end of last year. But within that, the growth has been one of the weakest performer throughout the year. Value oriented equities have done fairly well, and that is largely to do with the likes of energy. Energy have been one of the biggest positive factor throughout the year. So commodity prices, so oil prices have been benefiting, been supporting that. So I think there are many moving parts.
I suppose that's the thing, isn't it? There's many moving parts. There's been what one could say challenges in certain aspects of asset markets over the course of 2022, but there's also been opportunities and positive returns have been earned in certain periods of time. But I suppose maybe the one word that brings it all together was it was a challenging period for asset markets in general, bringing together some of those points that we were sort of highlighting right at the outset, really around central banks, inflation, the response of that as well. And I suppose maybe unlike many other industries where things reset, the clock resets on the 1st of January, unfortunately from an investment perspective, it's a continuation of those trends and those economic trends working their way through. And I suppose, George, from your perspective, if we think about economic growth, how should we be thinking about that evolving for the year ahead?
Well, hopefully for those tuned into our morning market videos, this shouldn't come as a surprise, but we've been through 2 periods of strong economic growth, and economic growth at this point in time is slowing. And we've been talking about the evidence of that here in the UK, in the US. Why is it slowing? Because you've got higher borrowing costs, you've got higher interest rates, which is a deliberate action from the central bankers to tackle the challenge being inflation. At this point in time, you've got higher utility bills for the consumer. That's been reflected with the energy bills, which we've seen dropping through the door. You've got one of the world's largest manufacturing hubs, which has been in tighter environment in terms of its COVID-19 policy restrictions. Now, we've seen some developments on that in recent weeks, which will set a certain tone as we look into 2023. But in the main, economic growth is moderating. We know that it's moderating largely by a slowdown in developed market economies. So economic growth through 2023 is likely to be largely driven by the emerging markets at this point.
Mm-hmm. And how does that relate to one of the things that we've been talking about, the central banks have been discussing, is the unemployment backdrop? And clearly we've seen unemployment be probably more resilient than, or employment I should say, be more resilient than we would have expected, just given some of the anecdotal evidence that we've seen. And how's that feeding into that sort of growth slowdown, but employment still remaining very robust?
Really important point. I think if we take unemployment levels, just for some context, in the US and in the UK, you're looking at unemployment levels of about 3.7%. So historically low levels. So you've got more demand out there for workers than what you have in relative terms of supply. There's always going to be a degree of slack because of friction as people move between jobs and some jobs which just aren't suitable. So you're always going to have some slack, but at this point, labour markets are very tight. What does that mean? It gives consumers more spending power in terms of they've got an income coming in, they've got more ability to get out there and spend, which in itself is driving part of the inflation challenge. So central bankers, if we take the Federal Reserve in the US, who have objectives in terms of inflation and employment, they've recognised in order to tackle the inflation challenge that unemployment levels are going to have to rise. Now, if we take the minutes from the December meeting, which were published just this week, we can see their expectations are for unemployment levels to rise by around 0.9 to 1% through the course of 2023. So unemployment levels expected to tick up, but we're talking about a move below a 5% level at this point in time. We're starting to see some anecdotal evidence of this across the technology sector in the US, but also in terms of how they're thinking about global operations. Global operations looking at this from the context of costs are rising, financing costs are rising, and they're streamlining their workforces accordingly.
And certainly we've seen that from a number of the technology companies over the past number of weeks.
Yeah.
Changes to their employment expectations, but not significant. I think, we look at the headline number, and I think it was at Amazon were something like 18,000, but it's about 1% of their global workforce that they're discussing.
Yeah. So in the main, you've got economic growth, which has been very strong, but expected to slow from those high levels for the reasons, part deliberate action, but part just actually some of the adrenaline from when we think about coming out of lockdown, as we did, roughly a year ago this month. Plan B was scrapped here in the UK. Feels like we've been free for some time, but it's only really some 12
and
months.
And that might be the thing, as you were saying there, with sort of maybe developed markets slowing, but emerging markets accelerating a little bit, and we're sort of in this midst of China abandoning that zero COVID policy, and how that might feed through into growth and obviously into inflation maybe
exactly
as well.
That'll be key to seeing, and we're already starting to see some live examples on the ground. If we look at Bloomberg in terms of what's happening with activity levels within China, the policies and restrictions are set to increase activity levels, and we are starting to see increased footfall.
And Kevin, maybe to bring you in on some of the themes for 2023, and in terms of what George is mentioning there, economic growth slowing, employment trends changing a little bit, but how does that feed into what central banks are thinking around inflation and the direction of travel for interest rates?
So I think we acknowledge that central banks are primarily worried about inflation and are going to use the jobs market as the main target to try and convince themselves that any fall in inflation is more structural than cyclical, so that when inflation does decline, that it stays there. I know that central banks can get inflation back towards 2% in line with their forecasts. My view is this is going to be a year of downside inflation surprises. So we're going to see, and not necessarily synchronized, but we're going to see downside inflation surprises over the course of the year. Mm-hmm. We know that the excesses from supply chain blockages has largely unwound, so we're seeing goods price disinflation. We're going to see the base effects from commodity prices roll over quite quickly. So for instance, gas prices in the US at the petrol pumps, to not be too confusing, are lower than they were this time last year. Wholesale gas prices in the US are now at a 1-year low. We're seeing wholesale gas prices across Europe being very low, perhaps more indicative of a milder winter. But also we're seeing Brent prices, global oil prices, at a 1-year low. So the commodity base effects will begin to roll off and pull down inflation quite substantially, mainly from the end of this quarter.
And that's certainly, sorry to interrupt, kind of quite meaningful in terms of when we think about over particularly this first quarter, where gas prices and oil prices got to, when we look to what happened on the 24th of February last year when Russia invaded the Ukraine.
Absolutely, and being very careful about forecasting, but current gas prices indicate that the energy price cap and the government intervention will come down substantially, and the government may not actually be intervening or having to cap prices towards the autumn. So the capillary pull on inflation would be quite significant. And then of course in the US we know that a large portion of the services inflation comes from this rental component, and leading indicators of that are showing that rental price deflation is occurring in the US, and that will feed into this official measure from the second half of next year. So I think that will be a welcome outcome, but I expect policymakers to push against it, particularly for the first half of the year, until they reach the so-called terminal rates, until they've finished hiking rates, and then they'll perhaps acknowledge a softer backdrop for inflation.
So the potential that both headline and core inflation are trending lower as we move through the year, but the expectation that central banks still have this very much tunnel view on we need to fight inflation, and unlikely really to shift on interest rates this year.
Well, I mean, I think the jobs data we've seen in the US last couple of days shows that actually there is remarkable strength continuing in the US economy, and for as long as that strength manifests in the jobs market, you're not going to shift the central bank view that further hikes are needed. They need to maintain the rhetoric around jobs markets perhaps too strong for this part in the cycle, and that they will look through downside inflation surprises in the short run, and that only if they became worried that inflation was undershooting their forecasts would we perhaps see that shift. So that might come towards the middle of the year, but certainly not this early.
And that's the sort of behaviour which the International Monetary Fund have been encouraging for central bankers to maintain their focus to target towards that long-term target of 2 to 3%.
Yeah.
And I think it's just maybe cooling in headline inflationary pressures will give them some room to breathe. Central banks to ease off. We have seen that a number of central banks have stepped down from the pace of rate hikes from 75 basis points, in fact, to 50 basis points. And if you look at Australia, you look at Canada, all have been looking to step down in the pace. And I think the cooling in oil prices, cooling in the base effects will give them some room to, despite having these elevated the job market being so tight. I think this probably provides them room to ease off a little bit.
And I suppose the contrast there is the change that we saw right at the end of the year in Japan, where moving away from their yield curve control at 25 basis points, all moving to 50. A little bit of an indication that even inflation in Japan has got to levels where they're thinking about it.
Yeah, and also these central banks are going to use any inflation impulse they can to try and remove this excessive stimulus that they've sort of got barricaded into, and the Bank of Japan has perhaps been the last to try and bring down some of the fortification. So it was a modest move if we think about it. So. And they've had to do, on the other side, they've had to do more bond buying to help support that. But it's certainly a signal for the direction of where central bank policy is going.
And one of the other things that we haven't touched on just yet in terms of the implication for policy rates is quantitative tightening and the speed that we will see that working its way through this year. How significant should we think about that, or how significant is that likely to be as we move through 2023?
So I think in the US it's actually got very limited impact. The ground was well prepared by the US Fed. These monthly runoffs, so they're not necessarily sales, but the failure to reinvest these maturing bonds is very consistent month on month. So, and also the Federal Reserve have put in place a number of other measures on the other side to help support liquidity. I think it's got more of an impact in the UK actually, because what the Bank of England doing is quite aggressive when you think about our economic backdrop here being less strong than the US. And also the UK is more reliant on foreign participation in our bond market. We require foreign investors to lend money to the government by buying gilts. And indications through Q4, the data we have published from the Bank of England, was that sponsorship has actually reversed and foreign buyers of bonds are actually turned net sellers. And that could pose a challenge in the early part of this year, given the Bank of England are accelerating their selling. The government is having to borrow more to support the energy price cap freeze. And if we've got foreign investors actually selling gilts, then there's not a lot of optimism. There's no one we can look to be the backstop. So nothing too worrying, but I think the UK has a challenge, and then obviously the ECB, the European Central Bank, are going to begin their runoff some point towards the end of this quarter. So it's just another pillar of monetary policy tightening. But what the ECB are doing is actually quite mild when you compare versus the Bank of England or versus the US Fed.
So UK probably in a slightly different position than other global economies. We've also, I suppose, got the theme there running through of very significant interest rate increases through 2022. We're not thinking about anything comparable to that for 2023. If anything, we're suggesting that central banks are much closer to the top of the rate hiking cycle of where we want them to be.
And certainly the one that, the tip of the hat I'd give to central banks in Q4 was they really did push market expectations to the top, really.
Yeah.
So, I think markets are well prepared, especially in the UK, for further substantial rise in interest rates. But on the whole, markets really seem to think that around about Q2, most of those rate hikes will have finished, and that we'll have reached these so-called terminal rates.
Okay.
Just for context, we were looking at some charts just as a reminder of what a year it's been. And coming into the year of 2022, expectations were for US interest rates to get to between 1 and 1.5%. Now we're at 4.5%, expected to get to 5.25%. So what a year it's been, and what an acceleration it's been in terms of central bank policy and the tightening of monetary policy, raising of interest rates.
And therein is the challenge. Trying to forecast, as you were rightly pointing out, Kevin, is exceptionally difficult in these periods of very significant movements in asset prices, and the reaction function of central banks has certainly been very robust in 2022. So very difficult to forecast outcomes, but certainly what we're seeking to do is to get a balance of those views and an understanding of the probabilities around those different scenarios as we look into 2023.
Absolutely.
Just one I think as we discussed about the tightening in the global liquidity conditions, but just one, China is slightly on a different path. It's an important path because they have taken a little bit of, because they were not providing liquidity at the time when central banks in developed markets were providing liquidity. So I think they have scope, and they need to provide that, maintain that liquidity tap, given the slowdown we have seen in China, and so I think that is one central bank's or regulatory environment which is slightly more benign for liquidity market, which could reverberate across the rest of the global, given the linkages to the rest of the global markets. I think that could.
I think it'll be fascinating this year to just watch and observe how China does react to the reopening of the economy and the removal of those restrictions, because I suppose you can look at it two ways. In the initial period, that might be a negative in terms of consumption and the service-based nature of the economy. But as we maybe get through this year, we might see a stronger impulse coming through from China into the global economy. But again, time will tell. We're not going to forecast one way or the other.
I think the oil market agrees with you, Jeff. I think the oil market is telling you that the reopening of the Chinese economy is not inflationary. The demand won't be there. There's going to be a number of issues with regards to society to work out. It's obviously a public health problem, and that the sort of the demand growth won't be there. But again, sensitive around forecasting just where the Chinese consumer will be, say in 6 months once we're into a northern hemisphere summer. But so far it's not looking to be inflationary.
Which is a positive, really, for the broad global economy at this point in time.
Yeah.
If we think about maybe bringing some of those things together, Raj, what you were introducing in terms of what happened in 2022, certainly the correction that we saw in bonds, in equities, has created some opportunity from a valuation perspective. Would that be fair to say, or should I be less circumspect on that opportunity?
No, I think you're right. I think the correction we've seen in 2022 has made many of the top evaluations as we entered 2022 back at December 21. If you look at the equity markets, were in the US were trading somewhere well over 21 times to 22 times the 12 months forward earnings, and today they have corrected to under 16 and a half times forward earnings for next 12 months or onwards. So I think we've seen a quite marked, given a 25 to 30% correction in P's is quite reflective of the slowdown which is equity markets have been expecting, and all of this we would expect. So I think we've seen quite a marked revision. If we bifurcate between two things, the growth sectors have re-rated much sharply. we have seen almost have 40% correction in growth sectors. So I think cyclical sectors like semiconductors or banks, for example, in the US have corrected almost 30-35%. So there are opportunities in the cyclical sectors. Value sectors, for example, they started a year around 14-15 times earnings from 2022. They have corrected to 12 times. So correction will be much less. Nonetheless, 12-time earnings for the next 12 months forward earnings is still a very robust valuation attraction there. If we move out,
I suppose that's the interesting point for this year when we look at earnings forecasts, and maybe even for last year to an extent as well. I think I was surprised that we didn't see the magnitude of earnings reductions that one might have expected. And I suppose the thing that we're all trying to grapple with is the inflation backdrop and that high level of nominal growth, and the impact that has on corporate earnings has probably been surprising for 2022, but equally so where I think consensus is forecasting 3 or 4% growth for earnings in 2023 as well.
I think that's an interesting point. That so much is the nominal earnings, but also the demand, consumer demands have been fairly strong, and that goes back to what George was mentioning earlier. The unemployment rate, the employment labor market is so strong, and the pent up savings in consumers have been so strong that consumers have actually been less reluctant to dial back in the face of slowdown. We are expecting to dial back their expectation, and their purchases have been fairly robust. I think that
and I suppose anecdotally that was something that you were just mentioning before we came on to do the podcast, some of the robustness that we'd seen in UK announcements over the first few days of the year, which seem probably to speak to a slightly more robust environment for demand.
So I think it's a micro viewpoint, but the head of Channel 4 was pointing out that the slowdown in marketing income they were expecting through Q4 directly through the companies who pay for ads, saying hits to their income streams, just didn't come through. So there is still an appetite to spend in the UK now. Consumers are definitely getting less for their money, but that nominal spending is still quite high. So I think it indicates that there definitely markets are perhaps too negative, the UK and Europe, on the outlook for corporates, and also that there is a psychological shift in the way consumers have reacted to COVID, have reacted to their lifestyles, the way they want to spend with their families. That's almost impossible to measure.
Yes,
but the on-the-run data is suggesting that some of the worst downside forecasts will not be realised this early, if at all.
And I suppose coming back to yourself, Raj, from a valuation perspective, if we look at the likes of Europe, the UK, Japan versus the US, there certainly is a valuation anomaly that could be exploited.
I think this is clearly, the US continues to be, given the quality of the earnings and the pictures that are there, and the consumer demand and the makeup of how consumers spend, the nature of the service side of the economy is much heavily represented in the equity markets. I think for all those factors, US continues to be one of the richly valued. It was much richer valued when we entered 2022, but clearly it's fairly valued is what we would consider. Which, if you look at a 25-year average of earnings is around 16-17 times, so it's fairly value from valuation perspective the US market. But if the opportunities are much more brighter if you move outside of US and likes of UK, which is trading around, FTSE is trading around 10 times earning. Similarly in Europe is around 12 to 13 times earnings. Japan is in the similar, but the biggest valuation opportunities, if one could have an appetite, is in emerging markets, and clearly China. If there are enough questions still out there. But I think from valuation perspective, likes of China and likes of emerging markets are probably much more attractive at this point. And growth versus value, the correction I spoke about, we have seen quite marked correction in growth, certain growth sectors, early cyclical sectors. If the downturn doesn't happen to be that severe as markets are expecting, we could see some decent earnings and decent performance from early cyclical sectors as well.
And one of the the things that you said at the outset was the really challenging year that we had for fixed income. And I suppose, Kevin, to bring you in on that, fixed income, very difficult year in 2022, given the backdrop that we've talked about. Is there valuation attraction there, or is it quite nuanced as how one needs to think
I
about
would
that?
say there's a once in a generation attractiveness with fixed income valuations, and particularly in the UK. So I think many of the negative news stories, which we're all aware of, the brief Truss prime ministership, depressed fixed income valuations to the point where they now reflect where they were almost 20 years ago. So to put this into context, you can now get between 5 and 6% on a very short-dated corporate bond. So this is a bond issued by an investment grade company, typically for around 5 years. And if you can get a yield of between 5 to 6%, that's actually very attractive. Now, it might not appear attractive today when inflation is at 10%, but if broad forecasts are right and inflation more than halves through the year, then if you're earning 5-6% on a bond as inflation hits 5 but it's falling towards 2, then you're getting a very attractive income stream from an investment grade fixed income instrument where you're going to get your original investment back within 5 years, as an example. And that sort of permeates out to other fixed income asset classes. We know that real yields, for example, globally look very attractive, particularly in the US. So you would get inflation added to the value of your bond, plus an income stream. Corporate bonds in the US, the yields on those are almost as attractive as the UK. Yields on high yield instruments, so they're not as creditworthy as investment grade corporate bonds, are also attractive. Particularly given we feel markets have very well priced where interest rates are going. And if we're now in this disinflationary cycle, falling inflation is the real kicker for bond markets. If you get slowing growth and falling inflation, then we don't have a period in history where bonds didn't do well in that period. And that's probably why the consensus view here and also in the broader market is that this could be a very good year for fixed income.
Okay. So opportunities certainly created by the challenges that we saw in 2022 and how
And I think
asset
those
markets
numbers
reacted.
Yeah, those numbers you detailed there, Kevin, in terms of the sort of yield which is available on a higher quality corporate bond of 5 to 6%. Beginning of 22, that was more like 2%. So that speaks to the challenge which has been faced from a total return perspective of holding bonds through 2022. But it also speaks to the opportunity set which our active managers have been discussing and exploiting through the second half, primarily the fourth quarter of 2022, in terms of putting capital to work and locking in that sort of return.
I think that's a great point, George, to bring out, because that is sort of the beauty of the solution, that our managers are able to look across asset classes and find opportunity, but really through the tail end of the third quarter and then the fourth quarter, it was very evident that they were really much more interested in fixed income and credit markets than we've heard them ever talk about in the recent 5-year period, I would suggest.
Exactly, and primarily those which are stock pickers, so identifying individual companies and taking advantage of the opportunity set, which was they were issuing bonds at a level which was required to be sort of north of 5%, which we haven't seen for some time. They were able to identify and invest in those.
And whilst we're only a few days into 2023, we've seen some of the trends that we've been discussing here be brought out in terms of the inflation backdrop, particularly in Europe. And I think, George, in Morning Markets yesterday, you were discussing France and Germany, some of the trends there.
Yeah, I did. I mean, inflation, as we highlighted, was a massively important topic through 2022. And at the back end of the year, we started to see those trends forming in the US of moderating inflation, which Kevin's alluded to. And then just at the beginning of this year, we've started to see the moderation of inflation in areas such as France and also Germany. So just for some context, inflation in France moderated from 6.2% to 5.9%. A lot of that is just some of the steam starting to come off the goods sector, as Kevin mentioned. Energy is still an important component. If we take the German figures, a lot of the energy moderation which we were starting to see was primarily a result of the fiscal support which government has provided in terms of sheltering the consumer from the pressures of rising energy bills, and hence the ECB still have more work to do to tackle the underlying inflationary problem. So what we're referring to is, yes, inflation is moderating in Europe, but the European central banks still have more work to do in order to bring inflation towards their target. And if we look at what we heard from the Federal Reserve, we had their minutes from the December meeting. Raj mentioned earlier that the Federal Reserve in December used a 50 basis point increase. Now that surprised some market participants because we've had a string of 0.75% increases. So what they were really taking was, okay, the inflation prints are moderating. That provided them with a little bit of breathing room in terms of where they can go from here. Still expecting interest rates to rise. We're at 4.5% now. Could go to around 5.25% according to where Fed member officials are currently estimating at this point in time. But what will be important is the pathway of getting there and the messaging along the way in terms of what they're thinking. They're recognising that unemployment will likely rise through the course of 2023, but it'll be of a magnitude of around 1%. And in terms of inflation, getting back towards target, they're looking at their preferred measure is what we call the personal consumption expenditure measure. At present, that's currently running at a level of about 4.7%. It's expected to get to around 3.5% by the end of this year and then around 2.5% by the end of 2024. So in other words, moving into that target range which they've set.
I suppose bringing some of this together from a perspective of 2023, we'd be looking at similar themes and similar trends, but maybe the one word that will change is that we talked about inflation and rising inflation through 2022. Maybe the term that we need to use more in 2023 will be disinflation, and what that actually means across the globe as we look to the year ahead.
And I think it's interesting that you speak of disinflation. One of the biggest hawks in Federal Reserve in the US was James Bullard, who has been always on the aggressive side of raising interest rate. Interestingly, he gave a speech earlier this week which speak about prospects of disinflation in 2023. So it's remarkable that there is recognition that disinflation is going to be the one trend which multiple participants, not only market participants, but also central banks are expecting to hit.
Yeah. No, I think that's right, and certainly for our viewers and podcast listeners, please do sign up to Morning Markets, also to the podcast, where you'll be able to get our views on how these key themes for 2023 continue to evolve. So thanks to George, Kevin and Raj for today. Many thanks.
Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.